Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, August 30th, 2021. It's a little before noon Eastern Time as I'm starting the video. I am back at my desk now. For those who missed it, I had to leave town suddenly on Thursday. My mother-in-law had passed away Thursday morning, and so we had to fly the family out and everything, take care of all the arrangements. So we're back, and I'm back at my desk now and been catching up on the charts today. Sorry I wasn't able to get anything out to you on Friday or over the weekend, but again, back in business now. And looking at things, here's what I want to do in this video is give you a very brief update on the equity markets. Again, there's nothing new there. We don't have sell signals. The divergences continue to build. That brings up something I want to address just before I left town on Thursday. There were two comments. I was trying to catch up on the comments when we got the news, and one of those was somebody spotting out or mentioning that they had crude at support. I'm going to update crude. I am still a longer term and intermediate term bearish on crude, and I'll give you updates, show you why. I'll go over the charts, and I'll just say this: I welcome differing opinions, second opinions, your own input, and criticism of my analysis, because obviously I can miss things at time. And I'll do an update on crude oil. The other post I noticed was every now and then get something about, oh goodness, Randy, these divergences you talk about them, they don't play out. And I've done this 100 times, and I like that. Again, I welcome feedback, so I'm just going to address it again, say the same thing I always say. I go to the long-term charts, and when I talk about divergences primarily on the longer-term time frames, I say a couple things. That number one, first and foremost, they are not a sell signal. Secondly, that divergences can and often do continue to build for a matter of time. This is a long-term chart of the S&P 500. This goes back into the 90s, and so yet right here at this point, again, it's hard to see in a video unless you have, especially if you're watching on a cell phone, larger monitor, you should be able to make this out or replicate this chart. Put a long-term chart of the S&P 500, draw your own divergences. You'll see leading up, there was a 22% bear market, technically speaking. I'm more of a correction within a larger bull market, in my opinion. That was the Asian contagion back in '98. Well telegraphed with divergences on both indicators, 22% drop. Market powered on up, continued up with those divergences expanding, getting even bigger, and that was followed by a roughly 51% bear market that lasted for several years into the late 2002. Again, so they're there. You can see all the divergences. There's the bull market top in October of '07, the Great Depression they called it, or the Great Recession, I'm sorry, with a roughly 56 or so percent drop in the markets back then. Divergence set up a couple years later. That took about a year or so to expand, 22% drop. We had some divergences building into 2015, followed by consecutive back-to-back 15% drops, each one with divergence ahead of it. And then roughly 20% drop, depending on what index you're looking at, in the fourth quarter 2018. We did have divergence as well. That's negative divergence on the S&P 500. And again, bigger divergence. So it was divergence that started back there in the fourth quarter of 18 and continued to build and led to a bigger drop. So right now, again, I would only be remiss if I didn't point out these divergences. So really, the day I stop pointing these things out is the day I should just, find something else to do. And I just wanted to bring that up. Now, that's point number one. That, and again, the other thing, besides the fact divergences often can continue to build for quite some time before they play out, the other thing that I often say is occasionally they do get burned through, meaning negated. And what that means is whatever security you're tracking continues to go up, and at some point you no longer have divergences when you don't have the indicators lagging behind prices. So all right, enough on that. And if you've been with the site for a while, you've heard me say that 100 times. But I get that, and I get new subscribers to the site that come in, and I just want to address that point. Now, much, much more importantly than that is, I always start these videos, or typically I'll start the videos with coverage of the equity markets, the broad markets. Keep in mind, the stock market, or the various, there's dozens if not hundreds of proxies to trade the stock market. And by proxies, things that track the stock market. You have ETFs, you have mutual funds, you have stock futures. You can play options on the markets, and to add to that, you have various indexes. You have the S&P 500, Nasdaq 100, Russell 2000 small caps. You have the mid caps. All right, so you get it. So what I'm trying to get at here is a call on the market or analysis as a market is one thing. To be bullish on the S&P 500 is to be bullish on the Dow 30. Because they're going to go up and down together, just like the Nasdaq 100. Why? Because they have almost the same components. The Nasdaq 100 has 100 stocks, and majority, but not all of those, are in the S&P 500. So to be bullish or bearish on the stock market is really to be bullish or bearish on all of those. Now, one will, and I'll often say this, one will underperform or underperform or outperform, I should say, one or another, meaning if the market drops, maybe the Nasdaq 100 outperforms or underperforms, and likewise if it goes up. All right, so I just wanted to say that, and so therefore, remember, analysis on the site consists of any analysis on the broad market is just one single trade idea, and throughout a year, I probably post 30. Well, gosh, no, much more than 30. If you look at the different types of asset classes, you have the equity markets. That is one single trade idea if you want to look at it that way. And yes, sometimes I'll throw out a trade idea on the small caps or the large caps, but for the most part, that's one idea. Now you have commodities, and although that's a completely different asset class, so here's your major asset classes: stocks or equities, commodities, fixed income or bonds. And then I'm, lumping some, a crypto into kind of its own thing. I usually categorize it along with Forex, but it is its own animal now. So if we want to, we can call that its own asset class. And now the thing is, the stock market, again, it's all those indexes for the most part are going up or down, larger trend. I'm not talking day to day or even week to week. Sometimes Russell will correct for a little bit, but when you overlay the charts, they're in the same bull and bear trends. However, commodities are completely different animals. So when we're covering commodities, as I do, and that's really been my focus, as you've seen for the last few years, gosh, you have at least a dozen different things under there. In other words, corn has little, if anything, to do with oil or lumber. And so there's multiple trade ideas. So when I'm focused on commodities, and you guys know this, at any one point in time, I'm bullish on these, bearish on these, and have no opinion on the rest there. Fixed income, I've gotten away from it somewhat since the Fed has stepped in and just completely, they've made price discovery virtually non-existent. They're heavy hand in the fixed income markets. Although I have come out and made a couple calls this year. You look at TLT when it topped down here, being bullish, and that's a long-term chart. And these are long-term trend trades. But again, you know that recently bullish back here, getting bearish again up here, and the bigger trades, and then Bitcoin, things like that. So I just wanted to say that, and these work out. Bitcoin is one example of a security that just works super well to the technicals, and not just this recent call. I've harped on this one, giving you a sell signal literally the day after Bitcoin topped, and then turning around when the final target was hit, saying cover shorts if you're still in it. The final target's hit and go long for a bounce, and then again, putting it back on as a short right here, and we're still there. So what I'm doing right now, I'm kind of now segueing into updates on all this. So there's Bitcoin. Here's your update. 39.25. Tried to pop it for a day, couldn't hold it. And again, that's still big resistance. And the reason I suspect it will fail is you have negative divergence. I know everybody is cross-eyed bullish right now on these cryptos. Some of them, especially the shit coins, have been running, like Cardano, and some of the smaller coins, they've been running up there. But the majors have kind of been stalling out. And again, they bounced here. Don't get me wrong. I was bullish there. Set them up as a long. They hit both targets. That's where I was comfortable leaving as my final target in all these resistance levels. And look, if we pop this, then I'll just say the same thing here. That's resistance. As long as the charts indicate that's it. I think we're going to go down here in the near term. Near term meaning the next few months. Let's just say it could happen in weeks, could happen in days, but we're probably talking a window of a couple weeks, few weeks to a few months till we get this next leg down. And most importantly, like anything else, one thing I will say, the one guarantee I'll ever give you in the markets is I will be wrong at times and you will be wrong, so stops are a must. Nobody bats 1,000. Take these trades, and it's why you notice I'm all over the place with the things I cover. One minute I'm talking about sugar, the next minute I'm talking about Bitcoin, and then I'm talking about coal stocks. And if you have a well-rounded, well-diversified portfolio, on a good day, if you have a dozen or more positions, majority of those are going to be up, and a few might be down. And even on the bad days, you're going to have some things that are up. So there's Bitcoin. Nothing's changed since I left. Same outlook there. Let's roll in. Well, I started out talking about the equity markets. Again, not much. This is a 60-minute chart, and I showed you that long-term chart of the S&P again. I believe I did. Let me just loop back to that in case I didn't. The SPY, I was talking about those, if I didn't do it already, these corrections and these divergences right here. Yeah, I did that. So there are your corrections. I do recall doing that in the beginning. Just checking things off on my notepad, and I hadn't checked that one off yet. And so again, remember the weekly charts, even if what's there, bullish or bearish setups and technicals do play out, it can take not just months, but literally years for those developments to manifest in the form of a trend reversal. That means rally or correction. And right now, we've been in an uptrend. So we're looking for the next turn. That's a big part of my analysis, catching turns in securities, whether it's the market or anything else. That's where the volatility comes from. And I know I'm throwing off all kinds of tangents here today, but also keep in mind, you've noticed that my analysis and trade ideas on individual stocks has been much, much lighter than in recent years for a while now. And that is because when the Fed came in with this nuclear option, we've been moving up with diminishing, especially lately, diminishing volatility in the markets. And you can see this tight price compression. I talked about the VIX being down, and it is volatility where you have trading opportunities in individual stocks. We had a couple periods of volatility here, but for the most part, it's been this slow and steady grind in one direction, and that is not conducive for swing trading individual stocks and sectors, because most things have been going up with it gradually. And then on that too, keep in mind, when you look at the performance year to date from the S&P 500, we are up. I measured earlier. I'll just tell you, you can do the same thing. You look at the December 31st close, or yeah, I think it was if we had a trading day on the 31st or 30th, 21%. And then commodities, where that's where most of my analysis and trade ideas have been focused, as well as my capital for long-term trend trading, has been back here in the commodity index. And this is probably the most diversified commodity ETN, and it is up 27%. So it's outperformed the S&P 500. It's up 27% right now, and was recently up 29%. And what I'm doing again here is segueing into the next update. So here's DJP. I did want to update this. Commodities have been strong. I still believe in these longer term. I believe that we've embarked on a new secular. Nobody can argue this hasn't been a cyclical bull market. We're up enough to meet that definition since the bottom there back in 2020, where commodities bottom, they're up 82%. And again, the case can be made, I believe, that we're in a new secular bull market. So what that means is we could have a healthy correction along the way, and it could last for weeks or months. We don't have to have it now, but I do want to point out where we're at. And I do believe longer term we're going to continue on up, and that is, again, for the case I've been making on various commodities. Longer term charts are indicative of a bottom, an end of a bear market that lasted for years in commodities and recently ended. So that's that. Where we're at now, that's long term. Near term, we broke this trend line, as I pointed out here recently. We also put in a divergent high, and we're back testing. Now, oil has a big impact, pretty decent impact. Energy stocks. WTI and Brent crude together make up about, these numbers were through the end of February, so they may have changed a little since then, but they still make up a pretty sizable chunk, about 16, 17%. And then natural gas, add that in there, that's another 8%. And so it is possible to see some of the other commodities go up. If I'm correct on crude, I'm still expecting, I believe that we put in a major top in crude, and I think that's also reflective in this chart. I've been in more of a hit and mode run, as you know, in individual commodities lately, kind of get in, get out with these swing trades because of this. This is, part of it. We've kind of been chopping around and in some of the ag commodities as well. So I'm going to get to that in 1 second. Let me show you DBA, for example. So if you buy or have DJP that I just showed you, you own just about every commodity out there. At least a very well diversified basket: energy, gold, agricultural commodities. But many times over, I've harped on this one if you want a pure play on the agricultural commodities. And you can see that one, unlike DJP, which is chock full of crude and things like that, is at a new all-time high. And it's also been bouncing around. It's been chopping around. And that's why I've had a lot of hit and run trades in and out, things like natural gas, wheat, corn, soybeans, things like that recently, because it's been more of a swing traders market. This is that volatility I'd like to see in the stock market, and then we'll start looking at some more sector ideas, individual stock ideas. But lately that's what we've had in commodities. Now, I do have to point this out. There's that divergence. I pointed out divergence back here on the RSI, and it did play out. Now we have divergence on the PPO and the RSI. So, for near to intermediate term, I'm still, maybe hold off. I've just kind of moved to more of that tactical kind of hit and run mentality for the commodities and reduce my core holdings, long-term holdings. But I do still believe we're in a long-term bull market. It's a matter of whether these divergences play out, and if they do, I'll certainly be talking about DBA back here at 1764. That's very nice support. And if that breaks, I'll talk about it again at 1663. Now, if we break out and burn through the divergences, because we've done that certainly on the S&P 500, that shows you that that at times, especially in a strong bull trend, divergences can get taken out, and that's quite bullish. So where we're at now, all I'm trying to say is we're at resistance on DBA. You can see these previous reaction highs, and you have divergence. So define your trading style. If you're a long-term investor, you can have much lower stops. If you're a more active trader and don't like to give back profits and don't mind being stopped out, even if you have to jump back in, you can put a much tighter stop and see what happens here. And look, it's also, if you don't believe in the commodities bubble, you're on the same page as Powell, who believes it's all this inflation is going to be fleeting. I've been disagreeing with him for a while. And so far he's been dead wrong, and he's just backed down, and he wasn't foreseeing inflation as a threat back here, and he only he's been acknowledging it finally and keeps dismissing it as transitory, and expects those inflationary forces to abate, even though the government just doubled their forecast for inflation. I did see that headline when I was traveling over the weekend. All right, so that's that. If you wanted to, like I said, take a shot at a short trade, there's no sell signals, so keep that in mind. All you can make a case to short at resistance and pullback targets. Well, remember, you're shorting. If you do, you're shorting an asset in a bull market or an ETF, really, again, broad-based, and that would be your pullback target there, roughly 1764. Okay, moving on to some updates on individual trade ideas. This is gold, more right now of a swing trade, but also a longer-term trend trade, because we just hit those on gold and GDX, those long-term buy zones, those support levels, and so it's a combination of both. And so far, so good. Remember, we had that stop clearing move, and gold broke the support zone right here. A lot of stops hit, but we recovered it all and then some, which again is bullish. Did point out before I left we had some divergences building, but guess what? They keep playing out for minor pullbacks. It'd be nice if we didn't have those, but we still do. So, I'm still cautiously bullish on gold. Again, we must take out that T2 level back here that was hit, second target when we went long right here on the bullish falling wedge breakout. Traded sideways for a while. That's big resistance, and so far so good. As I said, it's going to be tough sledding because this whole area is a lot of trades happen, so that's a pretty significant resistance zone. But we've been walking up into it, and we're close to the top. The divergence is still there, so I have to, point it out. And if they play out, they could play out for a sizable drop. However, at this point, I will say, and these are levels that were on this chart a long time ago, and the gold continues to respect those levels. And that one's 1777. That's the support. Ideally should hold. Anything much more than that, much more than just a brief whipsaw, is going to be bearish, especially if it starts, with these divergences intact. I will always tell you, where I think it's going to go, and I think the divergences will probably be taken out, and it's not just, because I've been bullish on gold. There's other reasons that I would override what I'm seeing here on the chart, so to speak, override these divergences, and that is my outlook on the dollar and the euro. So again, looking for a breakout here above T2, and if you don't want to jump the gun on it, then just wait for that. We're not far away from it now, and that's about 1837, say 1840 on gold. Again, gold futures. And now let's do a quick update on the dollar, the euro, and then we'll move on. Got a few more trade updates, and then we'll wrap the video up. DX, US dollar futures, had a little stay of execution. We had a bearish rising wedge back here, broke down, back tested, and it's not as if we didn't crack. We did, but my longer additional downside targets hadn't been hit yet. What happened is the dollar put a marginal new high, put in a little divergent low right there, positive divergence at that low, stair-stepped higher, but in doing so, it only extended the negative divergence at this high. And so where I left, I think on Thursday we were right here. I think we had just broken down, if I recall right, below that trend line there. And since then, and this is my update, we now broke that support, 92.80 or 81 roughly, and to me that was pretty significant support, and that gave us or has given us the next sell signal in gold. We broke down, we're back testing. If you're a dollar trader, I think it's an objective short entry on the dollar here. For actually, I would hold out for at least this 91,696 target, or just let it run, and you can put a stop. A lot of ways to trade. The expression, many ways to skin a cat. There's a lot of ways to trade. You can use a very tight stop, target whatever you want, even one of the shallow targets, or stop somewhat above that previous reaction high right there, and that's the US dollar. So again, the dollar trades inversely to gold, or gold trades inversely to the dollar. So if this happens, net, that's going to be bullish for gold. And then last but not least, I always like to look at the euro as well, because the euro trades inversely to the dollar, positively correlated to gold. This was a trend line I left you with last week. I'm going to modify it. I looked at it earlier. I just wanted to wait and do it in the video. And because we had a few spikes through it, I'm going to move this trend line up a little bit more, but it doesn't matter. We're still above it. Whereas we broke out and back tested before, you can say this is a breakout there. The only thing we have to do now, the euro's stalling out because there's this previous reaction high, and it stopped there. So if we can take that out, that's resistance. Boom, should run up to 119, 115. So you can trade. That's a trade idea in itself, or it's a confirmation or confirming analysis that you want to go long or add to gold, because if that breaks out and the euro rallies and hits that target, that should be bullish for gold. And likewise, if we take out 119.15, head up to any of these additional resistance levels, potential price targets, of course, that would also be bullish for gold. All right, next up, crude oil. Again, this one kind of put on my trend trader hat. We've had some swing trades in there earlier, long and short, mostly short on the way down, but pointing out these pullbacks to support, divergences areas where we're going to get a bounce, so you could cover a short, reverse it into a long. And I believe I left it on Thursday as saying, ideally, not absolutely necessary, but ideally we don't want to take out that previous reaction high. That's a pretty significant reaction high, and that's where we stalled out so far. The sellers stepped in. We're not really going down much, but we still have those divergences. Where I left it last week, we were starting to build some divergences on the 60-minute chart, negative divergences that is, after following these positive or bullish divergences here, and we still have those divergences. So there we are. If we happen to pop that previous reaction high, we have some pretty decent support or resistance coming in at 70.19, and as of now we've only done a 50% retracement. That's a run-of-the-mill counter trend bounce on this drop. So what I'm doing, I'll take my fib lines, grab this low right here and pull that line up to where oil peaked back here. I missed it. I didn't drag up high enough, so this line should be a little bit higher. But if you look to the left, this yellow line right here is the 50% Fibonacci retracement. Again, that's from the high down to the low, and so far that's what we've done. So we've had a run-of-the-mill 50% retracement so far of the correction. Hey, is it the start of, was this the start of a move up to new highs? Possibly, but I'm going to loop over back to the long-term chart of crude oil, and this is the one that I'm basing my this is where I'm again shifting over and putting a heavier weighting on these long-term charts. This is a daily chart of crude oil. Covered it many times recently. It was big support back here up until late 2014 on crude oil, and that broke, and it was support once broken becomes resistance. That's TA 101, Technical Analysis 101, or Charting 101. And we challenged it, rallied back to it, kissed it, and didn't look back. Fell, and then we hit it again. So look, if we take it out, yes, absolutely. Is that bullish? Yes. If we can take it out and remain above it, anything more than a little whipsaw stop clearing move. But until and unless I see otherwise, there's a more evidence than I need to say that was a significant, most likely going to be a significant top in crude oil right here. So that's where the short trade was entered at. Case made for a long-term short, and we had negative divergences. One thing to run into resistance, but when you rally into resistance with divergence, as you did right here, all the better. So in other words, going back to that 60-minute chart we were on a minute ago, sure, crude can continue higher. It can take out that previous reaction high. It can even take out the 61.8 fib. Really don't like to see that during a counter trend rally, but it can do that as long as it doesn't take out this level. Maybe it wants to go and have another check of that resistance level, and if it does, let me tell you this right now, if it does it anytime soon at least, it's going to look like this. It's going to extend these divergences. Why? Because look how low these indicators are lagging behind. So again, anytime soon means within the next month or so. If it hit it 6 months from now or whatever, it wouldn't. You might not have those divergences. And therefore, that's why my intermediate to long-term opinion isn't going to change anytime soon on crude, no matter what happens on that 60-minute chart. At least, again, anytime soon, that is. Okay, most of what I'm covering today so far, there are updates, and there's not many hard entries. A hard entry is something that is at support or resistance, where I think a bounce is very likely, or a breakout above a bullish or bearish chart pattern, trend line, etc. But the closest thing I have right now to hard entries are the miners. I'm not going to go into detail on gold because I did that last week quite a bit. Bullish. I've done videos on these, but I just wanted to reiterate this has been, was back here and still is major support for me on GDX, and gold had recently hit major support there, and pointed the miners out as very objective, one of my favorite long entries at the time. From there they rallied. It's not they didn't work. They rallied 30%. We're back there again. So I view this as another buying opportunity for the gold mining stocks. And like then, it's not just a pullback to support, it's a pullback to support with positive divergences in place. And so I would rather take this trade time and time again and be wrong. But sometimes divergences and support, they just don't work. But just keep it somewhat simple when you get these kind of setups, and these are my kind of setups. That's where you go. So I've been accumulating the miners, and I really have a little bit sweet spot here also for the silver miners as well. Now again, GDX, you're going to have exposure to the silver. Excuse me, I hit the pause button by mistake, but just look at this support right here. I mean, look at that. It was a major resistance right there. We broke out, had a strong rally, pulled back, support, 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 support. And this is a support zone, by the way. When I have two lines in close proximity, which I do, 37, 60-ish, up to about 39-ish right there. And so, you buy that support zone, and you also have the divergence. That's SIL, Silver Miners ETF. And again, I did a video the other day covering a lot of individual silver miners. Still some work to be done. That's not an all-in kind of moment, because you have a downtrend line that needs to be taken out. And you also have some of those big silver mining stocks that I think I covered, still with some resistance. But a lot of them, like WPM, Divergence, PAAS, look at this. They're just nice setups. And again, a lot of them at resistance. So my thoughts, to just kind of summarize this real quick, maybe a half position here in the miners. If you're somewhat aggressive, I'm what I call an anticipatory trader. I'll take things in anticipation of a breakout sometimes, whereas traditional traders will wait for a breakout. I'll try to anticipate when one's going to occur, and by doing so, you're catching falling knives. You're certainly going to get cut sometimes, but you get a much better entry price. Because I'll tell you how these guys work, especially these silver miners. When they pop, a lot of times it's with a big move in the futures overnight, and then this thing's going to gap up 5, 8, 10%, and you're not going to want to chase a 10% gap up, and then you get left, and then you watch it just going up and up from there. By the time you realize, oh shoot, I should have took that 10% gap up, because I still would have made 35%, up to that target there, or that even better up, the next one. That if we go back up here to the recent high 40.29, that's 54% return, and that is, look at that big resistance. And then longer term, you just roll back. If you break out, and then you start looking at long-term charts. Look at that level up there. That's our all-time highs, and if we break out, that's going to be very bullish. And if my analysis on gold and the dollar plays out, I expect that to happen. So these guys may likely be the beneficiary, especially if the stock market holds up. We could have a correction. Anything short of stock market crashes, you're going to see pressure on the mining stocks, just because the fact they're mining their stocks. No matter what gold and silver does, they usually fall with the market on big corrections or bear markets, but not on relatively mild corrections. Let's say it's 20-30% the next drop in the market. These guys could still rally. All right, I shouldn't spend too much more time on them because I already covered them. So let's get away from the miners. And lumber, I'm going to continue to provide updates. I've warned of these parabolic runs followed by big corrections. I will certainly say, although I anticipated the big drop in lumber, which might have caught most people off guard, how much I underestimated how far. I started stepping in here. I got cut several times on it, but I'm still long, pushing this trade right now. One of my favorites, not really taken off yet. A little bit of work to be done on the 60-minute chart, but value-wise and everything, barring anything short of a stock market and housing, crash, lumber prices. Remember, we're in a bull market. You might say, Randy, that's crazy. Well, we just dropped, 70+% in lumber. But when you look at the simple trends here, let me color up this tool. This was kind of a big multi-year basing pattern. We broke out here, and we're still above that previous reaction low. So if you look at it this way, up, leg up, second wave up, wave down, and we're still above that. If we can hold here and run up, that's going to be bullish. If not, we could just fall back and chop around in this range for a while. And again, like everything else, don't get married to it. It's a way to be diversified, and it's also been inversely correlated with the market recently, where lumber typically has a positive correlation. So I'll tell you this too, if you're bullish on stocks, the stock market, it's hard not to be bullish on lumber right now, because again, stock market keeps holding up, housing prices should hold up, construction should continue, and new home construction, that is, and lumber prices should eventually catch up. And again, if nothing else, forget about all that. You have nice, very nice positive divergence. This is the first time in a long time I have positive divergence on both the RSI and the PPO. All that while within a bull trend. I don't know. I think you got to love this trade. It's just not taken off yet, but I'm giving it some room on that one. Okay, next up is coffee via coffee futures. As I showed you, the chart of the ETN isn't as clear, but this one is, and I covered my long-term charts of coffee, and I have my final price target from a couple years back. We've already hit my second target for whatever it was. I'll get to that chart in a second, but this was it. Last time it was mentioned here, an objective long at the trend line with support just below that at 175, and so far it's rallied off the trend line from where it hit the trend line just recently. It's rallied about 12%. So and it's at resistance. I should say right now I have resistance, not big resistance, but I do see some resistance there around the 198 level, give or take 198.50, about where we are right now. But again, it's how you want to trade it. You could take some profits there, or just tighten up or raise your stops to protect profits and let it run, because again, I made the longer term case. Here it is. The longer term case actually, years ago, back here in 2019 when it bottomed, laid out these three targets. This one, which was hit right there to the button, 60% rally. And then the next target, 90%, recently hit. We kept going, overshot it, but we pulled back to it, and it was resistance that we shot through of momentum, and so that's where my next target is, at almost 230-ish area, and if hit, that'll be about 160% gain from this buy signal we had back here in 2019. So again, the commodities trade, and for those of you that say, oh man, coffee's just too overbought, missed the boat on that one. Just remember, when coffee wants to run, it runs. That's how a lot of these commodities work. Natural gas, lumber, for a lot of time they will have periods of consolidation. For the most part, they're unidirectional. You grab hold of a trend, now it's volatile, so a lot of traders will get shaken out, and that's again what I talk about. You have to define your trading style and your time frame. Are you a trend trader, a long-term trader, investor? And if so, you don't get shaken out on 10-20% pullbacks if the charts are still constructive. If you're an active trader, you want to sidestep a 20% pullback if you can, or even capitalize on it by closing your long and then shorting. Okay, and if you're still with me, I'm just going to cover last two updates, and both of these are trade setups, something I'm watching, not actionable trades. So these aren't even really soft entries, but I wanted to update junk bonds. Junk bonds continue to hold up. Why? Well, the stock market's at all-time highs, and so are junk bonds, and that's a sector or an area of the markets the Fed stepped in and saved when COVID first hit. But there we are. So we continue to, along with the S&P, junk bonds are at multi-year highs or all-time highs. I don't know, at least multi-year highs. And then I did tell you what I'm watching. Since there's a lot of distortion here, price distortion in the bond markets, and since COVID hit, but I'm watching the top holdings, and this is just a quick update there. So here's American Airlines. I just flew back on crowded planes on the way, full planes on the way up and back, but I can tell you this. Technically speaking, the markets are concerned about this. It's coming down. The stock is far off its highs right there, put in a divergent high. Big level to me right there, 1873. We've been tapping it. It was a lot of reactions back here, and then there's our primary trend line there. So that's what I'm watching. Right now, there are zero sell signals, just because it looks precarious, meaning close to support, close to some big levels. I always say support is support until unless broken. So we could bounce. Just levels to watch. I just wanted to give updates because these are all so close. CCL, Carnival Cruise Lines, again, a lot of these companies that would have went to the wayside when COVID hit have been kept afloat with by junk bond issuances and intensive or extensive government stimulus. But there it is. This one's pinched between a rock and a hard place. Resistance at 24.30ish right there, and the uptrend line. Break of that uptrend line would certainly be, we'll call it a yellow flag, and then a break of 1932 would be a red flag, while a breakout above 24.30 would be bullish. So watch it. Indicators are bearish right now, at least the PPO. And I won't go over each and every one. I'll just rifle through this. This one's at support, CNC. Ford has a downtrend line it's pushing against right now, but remember, we already broke the primary downtrend line, so this one is on a sell signal. Near term would be bullish if it can take out that trend line, but if we get rejected, we're going to come on down to my next target here, or first target, I should say, at 1120. And again, this is one of the top holdings of those junk bond ETFs. That's why I'm covering these stocks. TDG already broke down. Again, not really going anywhere, but it's below trend. It's been backtesting, has not been able to regain that trend line. So that one, you have a check mark for a sell signal, if you will. Again, a soft sell, not a hard sell, because of the fact it's really not, there's no impulsive selling since the breakdown. T-Mobile already broke primary trend line right there, moving down. Just kissed my first target today, support 135.18. If it breaks that, that would be bearish, obviously. Occidental Petroleum, CHY, Community Health Systems, and CCO, Clear Channel. There's only a few more, so I might as well go through them. So 223, break at 223, probably lights out for that one. Move down, drop all the way to 172, and then you're getting close to that dollar range, that penny stockville, which wouldn't surprise me if this one. I expect this one to go that way ultimately. As soon as all the juice in the market, all the stimulus is gone. BHC, THC, Tenet Healthcare, breakdown back testing. Again, that's why we don't have hard signals. They broke down, back testing, a little minor trend line, a little wedge there. So break of that wedge would probably do the trick and take you all the way down. I'll have to update targets there. And then last but not least, HCA, still above trend. And then to wrap the video up, coal stocks. Remember, we're having a counter trend rally in crude right now, and add to that, the majority of these have not broken down. It is one of my favorite sectors as a setup, but it's not even a soft signal. It's no sell signals right now, at least not in the majority. Too many are above trend. A couple are below trend, but there's BTU, and the other ones I covered, Arch, ARCH, well above trend right now. Divergence is in place. HCC still above all support. Well, we have support right there, and there's your trend line. So not enough breaking down in the sector. ARLP, but a lot of nice clean trend lines. So when these go, I expect it to be a pretty fast drop. There's one that broke down in backtesting, is backtesting, but again, until you have at least half of these that I'm just rifling through break down, and they're all. Again, I'm going to stay on this sector as far as updates go, unless we get up here and we're far away from the trend lines. But as long as we're close to these key support levels, we could break them any day, and I'll continue to update these. And that's about it. NRP already below trend. Same story. Those that broke down are kind of just on a little holding pattern, waiting for the rest of the sector to trigger sell signals. Now, if these start to follow through, let's say they backtest fail, they break down from these ranges, I would imagine that's going to put pressure on those other coal stocks that have not yet broken down. There's another one right on support, NC. All right, guys, we'll wrap it up here. Long video, but wanted to get all that out to you, and I'll continue to update. Keep it focused on the trade ideas that I see the best risk return. And I'll also try to continue to differentiate between, long-term, intermediate-term trends or trade opportunities, as well as the short-term kind of hit-and-run stuff. This has been Randy Finney with Right Side of the Chart. Have a great day.